This video will help you understand the generation skipping transfer tax, so more of your assets can go to grandkids or loved ones many generations removed, and less goes to the IRS. If you don't know who I am, my name is Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. As family wealth grows, it's not uncommon that the first generation is going to look to pass down assets to the next. And they might even be looking at a couple generations removed in order to pass on assets to the grandkids for college or whatever could be the case, first home, etc. Unfortunately, for generations of sizable means, if they are looking to pass down assets to generation 3 or a couple generations removed from them, they might get hit with what's called the generation skipping transfer tax. And so in today's video, we'll break down what that tax is, so ideally you can game plan around it. So let's jump in. Most people from an estate planning standpoint are probably just fine with things like wills, maybe living trust, revocable living trust, powers of attorney, healthcare directives, etc. However, if the estate goes unplanned, it's not uncommon that some of the assets will go to the federal government by way of the federal estate tax, and some could even go to the state as far as state estate taxes are concerned. The way that the typical generation flow of wealth would look like on a textbook basis is generation 1 would accumulate the assets. When they pass away, they're going to pay a couple bucks in federal estate taxes and potentially state estate taxes if they live in a state that has a state estate tax. Then generation 2 will get what's left over. Then generation 2, maybe they build those assets up even more, and when they die, they're going to pay a few bucks in federal estate taxes, and again, maybe state estate taxes. Then generation 3 will get what's left over, and on and on and on. Now, realistically, I think it's close to like 90% of families lose generation 1's wealth after the third generation. So in reality, does it work out this way? Not more than 10% of the time, apparently. But for the sake of this example, we'll just assume that the assets continue to compound and pass down successive generations. As you can see, estate taxes being paid every successive generation would demonstrate that each generation doesn't necessarily need those assets because they're dying with so much excess. So common sense would say, hey, why doesn't generation 1 just gift to generation 3 the assets that they otherwise were going to pass to generation 2, so that there's only one level of estate taxes being paid, namely generation 1's estate taxes, and they bypass generation 2, or they skip generation 2's estate tax liabilities and send it directly to generation 3. For a long time, this is what people did. But then in 1986, the IRS imposed the generation skipping transfer tax, which essentially factors in as a 40% flat tax on any assets that bypass a generation, so that in lieu of generation 2 paying their share of federal estate taxes, which may or may not necessarily be 40%, the IRS is simply just going to tax immediately generation 1 40% for passing on assets to generation 3. And that means if the generation skipping transfer tax is assessed at a 40% flat tax and the highest federal estate tax bracket on estate taxes is 40%, gifts going from generation 1 to generation 3 directly and skipping generation 2 might be taxed at an 80% tax rate. And that's because generation skipping transfer taxes and federal estate taxes are additive. You add them together for a total tax rate. And this doesn't just apply to generation skipping transfers within a nucleus family. The IRS defines a skipped generation by someone who's unrelated to you, but is more than 37 and a half years younger. Those people would be considered skip persons in the same way that anybody in generation 3 would be considered a skip person. Now, as far as unrelated people are concerned, the IRS defines anybody that's between 12 and a half to 37 and a half years younger than generation 1 would be considered in that generation 2. So those are all copacetic to pass on assets to in the typical estate planning flow. But anybody 37 and a half years younger than generation 1 is essentially going to be considered generation 3, and the generation skipping transfer tax may apply. Now, you really only need to worry about the generation skipping transfer tax if the assets of generation 1 exceed 12.9 million, or if generation 1 is married, if those assets exceed 25.8 million, because they can combine these together. If you're under those levels for the tax year of 2023, you probably don't have anything to be concerned about. And I say probably because there are some things you can do during your lifetime that would decrease your personal $12.9 million generation skipping transfer tax exemption. But as you can imagine, most people out there don't have more than $12.9 million in net assets, nor are they planning to gift their grandkids more than $12.9 million. But there are families that are planning to do that, and for them, they are going to want to be aware of this tax. Now, even if you don't have $12.9 million in net assets today, and you don't forecast you're going to be there by the end of your lifetime, you might still want to be aware of this because in 2026, at the sunset of the Tax Cuts and Jobs Act that the Trump administration implemented, our office is predicting that in 2026, we are going to see the federal estate tax exemption and the generation skipping transfer tax exemption drop down to somewhere closer to $7 million per person, which again, doesn't apply to most people, but it does apply to a lot more people. And of course, no one really knows what's going to happen by way of estate tax exemptions in the future, so this is probably good things to know anyways if you do have a large family and you are considering passing assets to Generation 3. Now, there are times where grandkids are not considered skip persons, and therefore there would not be a generation skipping transfer tax imposed on any gifts made to them. Namely, if someone in Generation 2, which was the parent of someone in Generation 3, predeceases them. For example, grandpa is looking to pass down assets to his grandson, but before he makes that gift, grandpa's son passes away. Well, the grandson would then step up by way of estate planning into the son's space as far as generations are concerned, and any gifts made to the grandson at that point would no longer be considered a generation skipping transfer. And this is called the predeceased child rule. So if this does apply to you, you can check out Internal Revenue Code section 2651E. But I would imagine if you're looking at doing something like this, you're going to want to speak to a competent estate planning attorney in this space. In addition, there's also like a 90-day waiting period. So even if grandpa does pass assets to his grandson before his son passes away, if his son passes away, within 90 days after that gift was made, the IRS basically just assumes that the son passed away before the generation skipping gift was made, and then it would no longer be considered a generation skipping gift. So, what are some crafty ways of getting around this generation skipping transfer tax? Well, the first one that comes to mind is the annual gift tax exclusion amount. And this is the amount of money that you can hand out to each individual out there and not have to report it on any sort of gift tax return, but it's a dollar for dollar decrease in your total estate. And if you combine this with your spouse, you and your spouse could gift every single person you know $34,000, and there's no tax ramifications for doing that. I mean, obviously, the faster you start, the better position you'll be, but it might make sense to look at some other strategies to gift sizable assets out of your estate. That $17,000 a year gifting exclusion is awesome, but if there's a huge amount of money we're trying to gift to the grandkids, it might be a little bit ineffective. But nonetheless, it's a great way to plan out ahead of time, gifting your estate down to, number one, decrease the chances that you'll be hit with any sort of federal estate taxes. And if you're in a state like Washington State, where the state estate tax is at $2.2 million, it might make sense to start gifting your estate down ahead of time if you plan to die with an excess of over $2.2 million. Another thing that comes to mind that combines the gift tax exclusion amount with a 529 plan is the ability to front load 529s with 5 years of annual gifting at once. Said another way, grandpa could gift each grandkiddo $85,000 to go into their 529 plan. And if he has more than one grandkid, you just do the math and do multiplication. In addition, you can multiply all that by 2 if grandpa's married and grandpa and grandma decide to gift split $34,000 times 5 to each kid's 529 plan. That's $170,000 into each 529 plan, presumably. In addition, if the grandparents have grandkiddos who are currently going to school, or, unfortunately, if they have sizable medical bills, the grandparents can always stroke a check directly to that institution for education or for medical bills, and those gifts are not counted towards the generation skipping transfer tax. Those gifts can be of any amount, and they do not hurt the annual gifting exclusion, nor do they affect any sort of taxation, nor are they taxed. And the last financial instrument, which we'll have to touch on in another video, are generation skipping trusts. Those are a bit more complicated and a little bit beyond the scope of just identifying the problem in this video. So we'll have to touch on that in the future, but just know that there are more tax efficient ways of passing assets to Generation 3 or to the grandkids than just an outright gift that might be taxed at a 40% gift tax rate and a 40% federal estate tax rate. So calls to action. If your plan is to pass assets from generation 1 to generation 3, and you are generation 1, or maybe you're generation 2 and you're talking to mom and dad about what they should do with their assets, and if you don't need the money, intuitively you might say, hey, just pass it directly to the grandkiddos. I would say speak with an estate planning attorney that can help you devise a more sophisticated strategy, and speak with your financial planner about how best to position the assets to do that. Because some assets work better when passing down generations than other assets. So hopefully that was helpful in bringing to your mind a potential issue with passing assets from generation 1 to 3. If you have further questions, drop them in the comments below or get in touch on the website. We'll get you squared away. Have an awesome rest of your week. We'll chat with you later. Bye.